all that's happening in the world right now. We've got Vivek Paul, our Head of Portfolio Research at BlackRock Investment Institute, joining in on the show right now. Vivek, hi, welcome to ET Now. Thanks for joining in. Vivek, history's told us that wars do happen and the markets also climb the wall of worry. Is it any different this time?
It's always impossible to guess the near-term news in environments such as this, as you say. But as I think one of your previous speakers outlined, I think the thing to watch is around energy prices, oil prices. And that's something that has moved materially in the course of recent days, something like 10 to 15% in the course of the last week. Whether or not that has a longer lasting impact on the global economy will very much depend upon the longevity of the conflict and indeed the spillover effects. But I think oil is what to watch.
On the flip side, do you think the tariff uncertainty is abated, or do you think the markets are still a little bit on tenterhooks about that?
I don't think it's abated, and I think we should anticipate this to be the new normal. We're in an environment where macro uncertainty is just structurally higher. And indeed, it's impossible, again, to my earlier point of trying to guess the next blow by blow in the tariff dynamic. What we should consider, though, is more the broader sort of impacts around this. Markets have played some element of a stabilizing role in the course of the last couple of months. Whenever we've seen extreme moves, we've seen actually market forces dictate a kind of shift. So, for instance, think about the fact that the US has very much reliant upon foreigners for the funding of its debt. Think about the interconnected nature of global supply chains. Whenever we push extremes in market pricing, that leads to automatically, I guess, some element of a shift in that policy stance. So I don't think it's behind us. What I would say is actually, moreover, the macro data is probably yet to fully reflect the impact. So even in an environment where, let's say, we have certainty from now on, we're yet to see that come through in the macro data. Recent macro data in the United States points to some of the growth impacts sort of playing out. We're seeing some element of small contraction in terms of the quarterly figures. We've seen some element of a slowdown in CPI, but it doesn't yet reflect the full impact because companies are yet to make decisions. They're holding off on account of uncertainty.
But Vivek, given that, the world is in so much flux on not just geopolitics, but, the repercussions and bearing of it all on the economics as well, what happens to longer term money? Would you say that US is not the most preferred destination in the long haul as well? Or do you think that view doesn't change?
Well, we've got an overweight to US assets in our sort of 6 to 12 month horizon tactical views. And it's led by the idea that AI as a structural megaforce will continue to dominate the global environment for a period of time. And the US has many of the best companies in that space and is really well placed to take advantage of that. And when I look further afield, when I look to the longer term, we need to start from the current environment that we're in. The US is the dominant economic player, and it's hard. It's hard. We've seen this in recent months. It's hard to massively change the shape of the global economy in a short space of time. So we'd anticipate US assets to continue to play up the bulk of investor portfolios. But in the long run, undoubtedly, no one can have certainty here. There's a much wider range of potential outcomes than there ever has been before. Long-term macro anchors that we've built asset allocations around for the last 30, 40 years are being more challenged. So I think the idea is that we should start by thinking US assets will play a sizable role and will continue to do that. But we need to acknowledge, as you've said, that the range of uncertainty in the long run is just unprecedentedly high.
Interesting that you say that earnings eventually are going to be backed by AI-driven earnings. That is, if one can, term them as that. Other than AI, Vivek, then, what do you think are going to be the driving mega forces that will dictate which way money is going to move across the globe?
Well, AI is one that I've already sort of highlighted here. This has probably been the dominant market story of the last couple of years, and it's got some competition, as I'll go on to, but it's been the dominant market story because this is transforming the global economy. It's shifting the way in which we interact with products and services, and it will have impacts immediately in technology, but it will have much wider lasting and wider impactful impacts across the broader economy. But it's not just AI. Geopolitical dynamics, we talked about that earlier. That is another mega megaforce that is transforming the global system. The idea that the way in which we produce things across the world are shifting. India, I think, is a net beneficiary of this. The idea of, if you like, a China plus one type sort of strategy in terms of export chains because of the dynamics between the US and China is something that structurally benefits India. Another thing that does is demographics. Demographics is another structural megaforce which for much of the developed world, indeed for China, is actually acting as a drag on growth. For India, it is the opposite. So here's three examples, I guess, of structural megaforces that cut across just regional dynamics. They actually play out in terms of sectoral dynamics and these themes. And I think that's the way in which we need to make asset allocation decisions going forward.
Okay, point taken. Vivek, hi. We also understand that you're positive on Japan. Help us understand what drives this confidence, because we're talking about the shift in geopolitics and how emerging markets stand again. But what about Japan?
Japan is another area that we think is a benefit structurally from the shifting environment that we're in. For the first time in a long time, we have inflationary dynamics that are on the positive side in Japan. We're seeing sort of a shift in sort of corporate reform. We're seeing a reawakening of the Japanese economy that has not happened for many, many years. And it is poised to structurally benefit from some of the shifting dynamics that we're talking through. So for a long period of time, we were in a stagnant growth, stagnant inflation environment in Japan. We are seeing a shift in that, and we think that actually that will attract foreign investor flows in the course of the coming years, and that's part of the reason why we remain overweight. So in our longer run portfolios as well, not just our shorter run, we'd hold a greater allocation to Japanese assets than a benchmark might suggest.
Right. Vivek, where does China fit into the scheme of things? The data points there definitely are looking up. Tactical money has been long China since the start of the year. But what about long-term money?
Well, for a period of time now, we've had a neutral view around China in the ultra-long horizon. It's not an asset that we particularly call out in our longer-term strategic views because there are some structural growth dynamics that are at play in that country and continue to be so. If we look at the impact of geopolitics that we talked about a little bit earlier, actually China is particularly impacted by the dynamic and the evolving trade rhetoric that's going on globally. If you look at the China sort of trade dynamics, the exports to the United States just in recent months, it's materially fallen relative to where it has been for most of the last decade. So it clearly is having an impact there. What China's doing is it's reorienting its exports to other parts of the global ecosystem. So, for instance, broader Asia. And I think we'll need to kind of wait and see how that plays out. But from the perspective of an overseas investor, if you think about the Europeans, if you think about the Americans, investing in countries in the broad sort of Asia-Pacific region, actually we think for us, India stands out much more than China for some of the reasons we've mentioned. And if I look at the flows in recent months, actually that is really backing this up. We've seen that some strong sort of flows of foreign investment back into the Indian economy as a result of, I think, this idea that there is structural opportunity in India. And I think that's where foreign investors will play more in the future than in China.
Okay, so that's the take. And you also spoke about India, but Vivek, what's your view on the treasury yields, the bond market in India as well as US? Because we understand that you're long on equity, but not looking that positive on bonds.
Yeah, and I think it's really interesting to think about the recent sort of shock to financial markets with the geopolitical tensions over the last few days in the context of that view that we have on bonds. Traditionally, there's an element of a safe haven status that treasuries play in environments such as this, and there's a fall in yields as a result of dynamics such as global macro tension. That is not what we're seeing. We're not seeing that for two reasons. We're not seeing that because of the potential inflationary pressures. I think we talked about that earlier. That's yet to fully reflect in the economic data that will have upward pressure on yields, but also the way in which the market is pricing the risk around US treasuries is different. For long dated assets, it is no longer seen automatically as the risk off, because it does indeed have its own risks. We've been saying for a while that term premia, or the compensation that investors demand for holding long dated debt in the US, needs to go up to reflect some of this. And that's not because we think term premium needs to get particularly wide from historic standards. It's just that for the last 10 to 15 years, it's been really compressed. And there needs to be a normalization of that in the US Treasury market before we get getting to levels that we find attractive from a yield perspective. When it comes to India, I think there's less of a strong directional view. But what I would say is if I look at the yield curve today, compare it to what I'd anticipate it to be in the future for India, it's not that dissimilar. So as a result, there's a relative preference for Indian government bonds relative to US government bonds in the long run, because we think US government bond yields need to appreciate from here, rise from here, which is a valuation loss for a holder.
But Vivek, what about Indian equities? Is there valuation comfort and earnings visibility? Or do you think in this flux that the world is seeing right now, India is bound to be impacted? And I'll tell you why I ask, because, at least the macro data points seem to be quite supportive. You've got inflation under control. You've got a significant interest cut by the central bank as well, and very accommodative at that. So, that definitely is going to give a fillip to consumption.
I agree, and that's why we call out India as a structural strategic overweight in the asset allocation that we hold. So from a long-run perspective, we'd hold a greater share of Indian large-cap equity than the market benchmarks would suggest if you're an international investor, and it is due to a number of these factors. We've not been making the case on the shorter run horizon up until now for the reason that there are some sort of tactical or nearer term headwinds that the central bank clearly is reacting to make that policy more accommodative. But the long run picture continues to be attractive for the reasons I've said. And I think you talked a little bit about valuations earlier. One of the things that has been mentioned in context of Indian equity valuations for a period of time is that if you just look at price earnings ratios and compare them to the past, they don't look necessarily that attractive. But we take a slightly different view. When we're looking at it, we're trying to sort of ascertain the gap between the risk premium associated with Indian equities, the earnings potential of Indian equities. And if we account for the fact that the earnings potential might be greater than we've seen in the past, the risk premium doesn't look that elevated to us. So we would find actually Indian equities broadly reasonably valued right now. And therefore, with that earnings boost that is likely to come from the structural mega forces, this is for an investor who has a longer run holding period, a good time to invest in Indian large cap equity.
Vivek, and very quickly before we let you go, your long-term conviction as well as your conviction for the next 6 to 12 months, where does that lie?
Yeah, well, I think we've talked about a lot of this already. In the next 6 to 12 months, we'd call out US equity, we'd call out Japanese equity, we'd be cautious around the role of long-dated US government bonds. When I look further afield into the strategic horizon, we'd call out India. We'd call out, for those investors who can access private assets, we think there's large diversification potential, idiosyncratic return benefits that would benefit an investor too. So there are some of the kind of key things that we're looking at when, in the long run, particularly infrastructure, I think makes a lot of sense right now.
Okay. And now I want your view on what you're making of the surge that we've seen in gold. The kind of run-up that we've seen over the last couple of months for gold has been unprecedented. Would you still be long on gold after the run-up, or now do you believe silver could be the next gold in the making perhaps?
Well, I think when we're thinking about gold, we've got to really understand why is it? What's been driving that kind of demand? Because on the face of it, you think, well, actually, given bond yields are now returning positive territory in the developed markets, it's not obvious why gold automatically rises in that environment. It's really linked to the conversation we're having the other side of the break, which is to do with the fact that the role of traditional diversifiers is shifting. Traditional diversifiers, such as, for instance, the US dollar, such as, for instance, the treasury market in the United States, are losing their appeal in the near run. We think for the treasury market, as I've said, there is a reason for that will continue for the foreseeable future. And in that environment, when investors are worried and when there's sort of uncertainty in the broader system, gold is something that makes increasing sense for those with a shorter horizon look through. And that's why we've been advocating taking that allocation position too. I think what I would say when I look forward, clearly with the ramp up in prices and clearly with the fact that this is uncertain an environment, we shouldn't necessarily necessarily think uncertainty means bad. And I think that's one thing that we need to kind of account for. Uncertainty means uncertain. It means that there's a possibility of positive scenarios from here, the possibility of negative scenarios from here. So undoubtedly, with the ramp up in gold, we need to kind of look at that positioning and think whether or not it makes sense in the context of everything we would advocate. We would continue to say, though, net, as of today, let's make sure that we are using gold more as a diversifier than some of those other traditional diversifiers in the near run.
Okay, Vivek, and before we let you go, also give us your sense on the central bank action. We have three major central banks that are going to be mulling their stance, their rates this week. Now, largely, while all of them were expected to keep their rates unchanged, do you believe that this escalation that we've seen in West Asia could change any of that?
I think the expectations, as you say, is for not material action, and I think that will be the case regardless. And I think, you know, the escalation that we've seen more recently is something that will give them sort of pause for thought and indeed factor into longer run decision making. But I don't expect it to materially change the course of what they were going to do anyway. So we don't anticipate major moves over the course of the coming week in terms of major central bank action. In the longer run, we'd anticipate that, yes, the path is likely lower, but at a comparatively gradual rate on account of some of those inflationary pressures continuing. Whether or not that's accentuated by the recent conflicts remains to be seen, but we think the path down is comparatively gradual.
Okay, Vivek, really appreciate you staying on and sharing your views with us. Thanks so much once again for joining us on ET Now. On that note, we'll let you go.
Thank you.